So welcome back to another episode of Multifamily AP 360 and today's our guest is Sid Shamin. Welcome Sid.
Thank you. Thanks for having me, Rama.
Sure Sid. A little bit about Sid. Sid Shamin is the founder and CEO and president at Headway Capital, a private equity firm in Houston, Texas with over 500 million of asset under management. Headway focuses on providing best-in-class multifamily investment opportunities to passive investors. Before starting Headway Capital, Sid worked as a technology engineer in a Fortune 100 oil and gas company, developing and managing more than 100 million worth of technical projects. Sid oversees the company's investment strategy and asset management, ensuring projects perform to their greatest potential. Over the past 7 years, Sid has helped hundreds of clients and passive and commercial real estate to their portfolio and diversify from Wall Street. He currently resides in Houston, Texas with his wife and two kids. So, with that said, you want to add anything to your background?
No, that's perfect. Thank you.
Awesome. So you have grown Headway Capital to over 500 millions in asset under management in just 7 years. So what operational discipline allowed you to scale without sacrificing investor trust?
It's actually more than 7 years, just to correct. I think I started my journey as a single family owner, a rental houses owners, and I got to a point where at one point I owned more than 30 houses and I started selling all. The process been pretty standard is developing people, developing team, and making sure they are able to do what they are good at. If you ask me what is my 80% of time spent, you and other people that I know, you probably have seen very few marketing stunts or my presence on social media, except talking about developing people and processes. So to me, I think when we categorize within Headway, we have about 200 people employee plus minus, depending on at what time we're looking at. And sometimes I joke around with my wife, we are a recruiting company. We are not no more really a real estate company. People is a big aspect. It's our biggest risk as well. And 80% of my time goes into developing them, nurturing our staff. And then automatically that takes care of our investors, our residents, and our real estate, really.
Yeah, thank you very much. So you're focusing on developing people and building teams, right? So
Absolutely.
when you're bringing like other people, other team members, what do you see in them?
Usually we categorize into A, B, and C players. Now, remember, I'm saying players, I'm not saying people, right? Because you could have an amazing person that may not be a fit for your organization, right? Wh- I'm going to talk about the process a little bit, and then
Yeah,
I'll tell you what we look. So
sure.
we something called RPRS, right? People, right seat, and we do it on every Monday, right? So all the leaders in the company, we meet every Monday at 8:30. And the reason I picked that 8:30 Monday is more of a significance than anything else. I want my leaders, my people who are our supervisors, our managers, our CFOs, investigation people. I want them to keep thinking about when they're not working, they should be thinking about their team, right? Who should we help? Who should we grow? And the reason I always tell my teams, look, guys, it's 8:30 on Monday is purely significance, right? It's not going to give us any better results if we do it Tuesday 4 p.m., right? But the Monday 8:30 p.m. is my way to telling you that you should be ready to talk about the right people, right place, the first thing of your week. And that's how important we pay attention. Now, how we identify, really, we have a four quadrant: high trust, high skill, and low trust, low skill, and then two other areas in between. And that's how we categorize people. The skill set and the trust level is more important than anything else. And that's how we place our team members. If we lose trust on one of our team member, our skill set doesn't matter, right? That's one KPI or one score that we keep our team. The other score we give our team member is really ABC players and A plus players, right? Remember, these are right people, right place. If I hire a rocket scientist and try to ask him to manage a property, that awesome person, a smart genius person, will suck at it, right? So our job is to find the right person and put them in the right place and make sure they're growing in their career. That's my responsibility. One other thing that we take it very seriously is when we interview somebody, we tell them very clearly, we have a double dip bonus program, meaning if you meet your bonus for the year, we will double your bonus for the next year. So let's say you're supposed to make X amount of dollars today. You made X or very close to X. Your X will become 2X and the other X will come in next year. So, and that leads me to the third point. When we go from our A, B, C, and A plus players, your A player will bring you the problems, will bring you the solution, and will solve it for you. B and C, we can talk about later, but really what I try to look for is who is doing this, meaning who is my A player. And then there's an A plus player in my definition, meaning they are doing it in so fast that nobody else can beat them. Right. So they're hooked to their problem solving skills. Right. That's how we really categorize in our RPRS every Monday.
Awesome, and thank you for elaborating on that one. And you do have some engineering background. So coming from a Fortune 100 engineering background, managing 100 million plus projects, how does the systems-based thinking influence your underwriting, asset management, capitalizing today?
Yeah. No, it's a blessing as well as a curse, right? As an engineer, you can overthink and you can beat a dead horse and really over-engineer something. And that's what I did in first few years. My first deal back in 2014, 2015 is after underwriting almost 138 properties. And I was like, man, they just aren't gonna. And if you're from the same background, you probably know what I'm talking about.
Yeah.
I quickly realized that we need to have a process. Right now, we are doing some use of AI. We have analysts to underwrite those deals. And I think we're underwriting anywhere between 15 to 17 or 18, sometimes 20 deals in a week. And that's quite a big number. And we have everybody say that they're very conservative underwriting. I've never seen a syndicator saying, oh, I'm very aggressive. This is never a case. Really, the point is you can underwrite it. Yes. You can show and present numbers in a very awesome way. Yes. But really, at the end of the day, you're running a business. And that was my biggest learning. I was not running a business. I was behind computer and managing team and managing processes. That really helped for sure. But as you and I both know, when you're running a business, especially, you're dealing with the biggest difference is when you're coming from a corporate world, you know the process, you know the value of process and systems, but you're dealing with high caliber people who are PhDs, people who are double masters, and they're very technical and they spend 40 years in one field. You don't have to teach them, you don't have to keep them accountable. They are self-disciplined, they're accountable. But when you come to a lower technical level of business, say real estate or managing apartment complexes or other things, you're dealing with a different kind of person. These are the employees who are very street smart. They know what they're doing and they understand one thing, right? Is that how to operate it fast, how to operate it to a point where you don't have to tell them what to do. But their self-discipline and keeping them accountable is challenging, right? Now, I want to make sure that I'm not exaggerating my statement here, right? There are obviously exceptions, right? There's some goods and bad ones. But my biggest challenge was how do I take my system and processes, apply to a different caliber of people, right? And that because of that reason, all of my learning I felt was not applicable when I was doing this. Obviously, yes, when you're talking, let's say I'm talking to you, I'm talking to investors, I'm talking to brokers, and that really helped because you can communicate, understand, and connect with those kind of employee tell I call them, and then different kind of employee. Imagine if you're a CEO of your company and you don't know your porter is having problem because your sewer line is back up, and he's telling you that your jet machine is broken, and you can, as a CEO, you cannot understand what a broken jet machine looks like. So I gone from there to that level to understand what's in between, and right, that's where the operation skill set comes in. So to answer your question, yes, it really helped, but then again, like I said, it's a blessing as well as it's a curse. And the curse is that you gotta leave those, you gotta stop yourself from from the processes and assuming that everybody will be accountable on their own. That's not the case.
Yeah, sure. Thank you. Let's shift towards multifamily investing side. And last few years, we all know like it's challenging environment, compressed rent growth, tighter lending.
Yeah.
But yeah, and from underwriting point of view, what has changed most about how you evaluate new multifamily acquisitions in 2026?
The first thing I'll say is definitely expenses, right? We take pride in our internally in our company when we are comparing our expenses with other properties. I can almost say with very high confidence that our expenses are much lower. And there's several things that we do. We have a very strong process to decrease expenses, but when we are underwriting it, We're not assuming that aggressiveness in the expenses because few of the things that are not in our control. Employee payroll cost is not in our control. Material supply costs are not in control. So we're definitely improving that. The other thing we're doing in our with the title lien market is obviously lower leverage, high interest rate that everybody's doing. One thing we also, I personally is when if we can have a bridge loan for 2 3 years, right? Will that help me get to 2028, 2029, where expectedly your lending environment will be much more predictable? So we are doing a lot of that as well. We actually did one, and we are refinancing it into a fixed loan. And I'm glad we did that about 3 years ago. That we bought 2 years ago that we bought a property, and that property really helped us. That bridge loan that really helped the property to get over this 2023, 2024, 2025 time. And now we're about to refinance it in 2026 in a fixed loan. So that strategy is, I like that strategy because your short-term bridge lending will let you get out of the loan without any prepayment penalty.
Yeah.
And whatever you pay higher in leverage for a fixed loan, you can buy the rate cap or the swaps
Yeah.
to offset that. So that really help. I think the last thing that I would say, given this challenging environment, what has changed is that we've been trying to, I personally, I'm calling myself price per pound guy, meaning we're not paying the price that we paid in 2019 and 2020.
Yeah.
Our pricing on these asset types has reset significantly, and we are very well aware that this is a buyer's market. This is not a seller's market. We're not selling anything because we know we're not going to get the price.
Yeah.
And that's our focus, is to make sure being staying realistic in the expenses. The rent increase, we're not going aggressive on rent increase, maybe 2%, rent increase, maybe 3% in some cases.
Yeah.
But we are looking for price per door. We recently bought one property, and it was purely a price per door play that we bought from the foreclosure.
Yeah. Got it. So you touched about like controlling expenses, what you guys are doing. So would you elaborate a little bit more
Yeah.
about where exactly you're cutting expenses?
Yeah. I can literally speak for 2 hours on that, but I'll keep it short.
Yeah.
We go super aggressive on number one is on utility, right? So our standard is which one we can go aggressive on without going aggressive on the payroll, right? So our payroll is the last thing that we touch. We want to pay our people the top dollar that they cannot find anywhere else. We want to take care of them in the sector.
Yeah.
Obviously, we're staying competitive with so many other things as well. Not just the money is just a part of it.
Yeah.
The actual growth. So the utilities, right, is something that we go aggressive on. We do all of the utility changes in house.
Yeah.
So if our competition is, let's say, 100-unit apartment complex, water conservation projects for our competition will probably cost them about 40-50,000 bucks. Our cost is half of that because all we have to do is buy a toilet, and three of my guys can knock it out in 3 days, in 3 weeks. So that's one thing we do. There are other techniques within Texas market that how you bring your utility costs down, and we are applying that as well. I can almost tell you it's our trade secret almost. In our times, we do something called soft conversion of toilets, where we don't change the whole toilet. We do some tweaking and see if that helps. We also have some other ways to gauge some pushback on some bills, and that's something we do that. So utility is a big part. The other big thing, insurance costs, we have a master policy. So our insurance cost is much lower than most of the people. And then we have been working very aggressively last 3-4 years. We learned a lesson that you got to work with your insurance broker,
Yeah.
and keep them accountable on exactly knowing how they're bringing this cost. So we got very creative and brought several layers of reinsurance in between to make sure that we are bringing the cost down, not only by using a master policy, but also bringing the reinsurance on several layers. We also, property taxes, we stay aggressive on it. We go all the way to litigation level.
Yeah.
And that's all you can do, really. We have a very good consultant that's been helping us for the last 15 years, and he knows our expectation. We don't pay them out until we receive the funds. That's a big difference. A lot of operators pay the invoice up front. That means your expense is gone, right? We don't pay them unless we see the money being refunded into our bank account. And that is a 1 year difference. And that's where a lot of times I try to tell our teams, like, look, that's where the difference comes with your experience. If you're experienced, you will know those things. You will do those little things that make your business a little bit more aggressive, a little bit more better. We have our own AI-based CRM that we built. So we don't pay a CRM outside. That is minimum $100,000 of expense in software that we are saving throughout our portfolio. And in my company, we're more about scorecard and less about reports, if that makes sense. So
Yeah.
if our Monday reports for our managers really is a scorecard. They tell me how many move-ins, how many move-outs, tell me who you're collecting, who is on eviction, things of nature. We hardly see we see a box score, but what we really talk about is a scorecard, right? What's your delinquency and how are you going to, what's your plan for XYZ unit? Most third-party management companies, they run a big Monday report and they make a big deal out of it. We have tried that. We don't really see results out of it. Scorecard is a big deal for us. In my company, we try to keep everybody on the scorecard. So going back to expenses part, the marketing is saving CRM, having our own CRM with AI-based conversation CRM. We utilize a lot of implementers offshore to help us implement those systems. That is a pretty big expense. I'll give you an example of small example, right? Each property will pay $400 or $500 per month on just the website hosting. You don't know that. We get the website built one time. That costs us probably a few $1,000, and then we implement that with our CRM, and that's it. We're very heavy on some of the ad marketing, and that's where most of our money go when it comes to marketing. So our admin cost is very low. We try to go paperless as much as we can. So our office don't print leases, and there are a few things that you can do. You have to do, like your notices, your paper notices, your eviction notices. So these are all the things that comes together to really make a difference. If my competition expenses is 55% or 50% of the expense rate of the income ratio, mine is more about 46, 48, 45, sometimes 43. Lowest is our expense that I am running on one of my properties about 38% expenses.
Yeah. Thank
Sorry if
you.
I'm taking too long on
No,
answering.
that is really helpful for operators. So how exactly you're operating in cutting
Absolutely.
expenses as well, especially. Yep. Thank you very much. Let's shift towards capitalizing side. Passive cap isn't as easy as it was 2021. How has investor psychology shifted and how are you adopting your communication strategy?
Yeah, it's a loaded question, really. But I can tell you one thing which we have raised in 2024 and 2025. We
Yeah.
did not buy anything in 2023 because nothing was making sense. A lot of it is also, it all goes back to your communication pattern and skills and transparency with your investors. And I'm saying transparency not because it's forgiven, right? Like you gotta communicate as clearly as you can, and transparency is the default thing. Otherwise, you don't have a business. We are
Yeah.
in a trust business, really, if you think about it. And trust only comes when you consistently sh- share things on a regular basis. So that helped. We definitely have some not so happy investors because things have been tough on some of the 2022 and 2023 years. And three of our property minimum, we had to pause distribution because our interest rate spiked. And I think before our interview, I was telling you that I can, it's terrible to say, but we are the very few of the operators out there who haven't lost any of the deals. One of the things that really helped me gaining the investors' confidence was some of the deals that we were going through, some refinances as the rates spiked. We personally wrote our personal check to fund the property to make sure we're catching up with the payments by during the time we're refinancing. That would not have helped if we didn't have the NOI and our operations were in line, right? So that shows investors that we are confident. I'm confident to put my own big six figures check, personal check to the property because I know that it will eventually perform, right? And once we have it into fixed rate. So I think that really helped. That helped us in last year we raised about 17 million. I'm sorry, 13 million. And then we're on schedule to raise another five. So I think that, and most of them are repeat investors, people who have invested with us in the past.
Got it. Thank you very much. So let's touch on a little bit on market cycles. So we are moved from aggressive appreciation or operational efficiency. How has your strategy shifted from growth focus to margin production focus? And what do you see from market cycle point of view in the next 5 years?
That's a great question. I think I'll split it in two parts. Number one, I think we are definitely in a buying market. And I also think that it's going to stay like that for at least this year, maybe next year. There's a high chance that we kind of go into a very slow growth in 2026 and 2027. If any of your audience or you would go to my website and see my January webinar, we do once a month webinar, just like you, Rama. And my prediction has been is that it's going to be a slow market overall from the economy. But when it comes to multifamily, particularly, or essential services, medical and other real estate classes, I think those are still not going to get impacted as badly as other sectors. Recession impacts everything, right? It's really a matter of what's more recession resistant versus recession proof. So nothing is recession proof in my language. The next few 5 years, I do think by 2020, 2030, the next 3, 4 years, we might market might still rebound. You and I probably still seeing A-class products super expensive still right now, right? Because there's a capital need that needs to be deployed in multifamily. Multifamily fundamentals are extremely strong. People are still chasing that. But I think what I'm particularly talking about is workforce housing transitioning into, or A-class clientele transition back into workforce housing. That's going to happen quite a bit in my view. So I think it's definitely a buying market. We are underwriting, we're trying to buy as much as we can without stretching ourselves too much. It, People talk about timing. Yes, timing is everything. But I'm gonna split, like I said, I'm gonna give you two sides of this answer of this question. The second answer I would say is that when you're an operator, when I'm talking to my operations team, I'm telling the guys, we are operator first, right? So if it's a good market or bad market, doesn't matter. We still have to make sure, that one good example is if you're a roofing company and you're unfortunately in a location that half of the year it rains. So that really means that you have to recover all of your income, generate all of the revenue in the other half of the year when it's not raining. And that's exactly what we have to do. Right? So as when we are operator, we have to constantly improve our processes, our operation, and and make sure we're staying profitable. That's just the only way to get around it.
Yeah, absolutely. Absolutely. So, what are you guys focusing next 2 to 4 years, 2 to 5 years?
We're multifamily operators, so
Yeah.
that's over 90-95% of our work. We in last 18 months or 19 months, I have been looking into one other asset class that I think is going to help us, and it's more of on the hospitals and micro hospitals and medical buildings, medical commercial buildings. My wife is a physician, so that also kind of helped force us to look into this asset class because the clientele over there, the tenants are high caliber, and they hardly move unless and until they retire or pass away, right?
Yeah.
And these doctor groups, the physician groups, they have a very strong presence in a location, especially when they're in one location. So I think that to me that comes under essential service business. Is boring business and it's not going away. If somebody is needing to go to an orthopedic or cardiologist or oncology,
Yeah.
they got to go. There's just no way they're going to see a recession. Because of recession, they're not going to take care of them. And there'll be some impact on how the insurance market is behaving and the reimbursements and things of nature. But overall, I strongly feel that this asset class is prone to be more resistant uh, in this upcoming market. And that's one thing that we have been actively exploring. Our principle has never been to deviate for more than 1 degree from our main focus. And that's why it took us, I want to say, about close to 20 months to research and make sure that if we're moving and shifting our focus, we're doing it for the right reasons.
Awesome. Thank you very much. So let's shift towards personal side. Any
Yeah.
personal, any personal habits that are helping you to be successful?
Ooh, there's so many personal habits that are keeping me to be successful. I can definitely talk about that. I have so many bad habits. I think not giving up is extremely important for anybody. I try to focus on bigger picture more. In personally speaking, I think health first. If I want to order it, it'll be health, family, business, faith, in this order.
Awesome. Thank you. And any books that impacted you personally?
I have a unique philosophy about books. I know a lot of people likes to read book. I was
Yeah.
one of those where I used to read 10 plus books in a year. I've slowed it down. And what I've been doing is I'm basically picking topics that really help for me to execute in a business. So, for example, if I'm struggling with not finding great ideas about how the marketing should be happening in my company, well, I pick a marketing book. And one of the book that I really like is 100 Million Leads by Alex. It's a really good book.
Yeah.
The other book I would say Maxwell's Leadership. Any book
Yeah.
that you pick up from Maxwell, that's really good.
Yeah.
But my advice to people who are looking to make a difference, take those books as your textbook.
Yeah.
Right? If you're reading it, make sure you're applying it. And if you're applying it, make sure you're encouraging other people and spreading the word. So to me, reading those books as textbook and as a practical book is extremely important. If I'm not applying it, I'm going to forget.
Yeah.
And my strategy has been is to go deep into one book. Obviously, we can always, we got to learn and broaden our horizon of what's else out there. But when
Yeah.
it comes to business, it's all about execution. And that's what I try to do.
Yeah. Yeah. Absolutely. Thank you for explaining that. So how can listeners can connect with you, Sid?
They can go to my websites. It's headwayinvestment.com or they can email me at sid@headwaycapital.us. Our website is our best way. And if you go to our website and schedule a call with us, that'll probably be the best way.
Awesome. And thank you very much, Sid.
Thank you. Thank you, Emma.
Thank you.